talk more on this. We are joined by Mr. Chander Agarwal, MD TCI Express. Good morning, sir. Hi. Welcome to the show. Revenue that we've seen growing almost at 8.7% versus that was given of almost 15%. What specifically disappointed here on the revenue front, and is the full year 13 to 15% guidance still intact?
Let me start by saying that the full year guidance of the 12 to 13% is still intact. No change in that. The fall in, even though we have like a 9% growth in the Q1, and our sectors, our businesses like the e-commerce growing above 60%, and even the air cargo business growing at 30%, and in Q1, and even the international business growing at about 25%. In spite of all the geopolitical situation, I think a little miss in the guidance given of 15% is something which we will cover up most likely by the year end. Again, we are right on track in achieving what we have guided from the beginning of the year.
All right, Mr. Agarwal, now fuel surcharge passed to 90% plus to customers in June. Now, quantify the expected EBITDA margin benefit in Q2 in basis points, please.
So already our EBITDA from last year is up by 12%, and going forward, I think with the fuel surcharge and everything that we're charging, there should be another maybe 200 bits or basis points of further expansion in the EBITDA growth in the next quarter.
Okay, let's talk about the e-commerce segment, grown almost 63%, but is still almost 2.5% of your revenue. What's the quarterly revenue run rate needed to reach your 5% mix target, and by when can you see this happening?
So the interesting thing with our e-commerce business is that compared to other companies, it's very profitable for us. And we like to take it slow and steady and not be on a run for high top line numbers, because that'll automatically affect will give us lower bottom line numbers. And looking at that trend, the 5% of the revenue mix is something that we are not aiming to have it like in a very short period of time. We want it to be at least in the next 2 years. We expect this to be at least a billion rupee business for us. So with that, with a billion rupee business, we expect at least almost 15 million rupees, or sorry, 150 million rupees as profitability as well. So this is something that we are doing, and we're right on track.
Now, Mr. Agarwal, branch network has crossed about 1,000. So are you looking at further network expansion? Is that something that you're looking at as the key growth lever, or does automation-led productivity improvement take over from FY28?
So it's a mixed bag. You know, you have to have automation and the branch expansion. 1,000 branches would mean that now we're able to deliver to 60,000 locations and pick up from about 50,000 locations, which is one of the largest network that we can have in Asia and India as well. Now, with that, we are able to deliver also to 200 countries. So network, I think expansion is something which will add to the top line, and of course to the bottom line as our pricing increases for those locations. We will see that adding in as well.
All right. Kolkata and Ahmedabad hubs to be automated by FY28. Now, what's the expected throughout improvement and cost per kg savings from each automated hubs?
Kolkata being one of the largest sorting centers that any company will have in India, and I think the saving as such, I'm not able to quantify at the moment, but overall, you know, the important thing is that with automation, the throughput time reduces, and that is more critical. And with that, when we have a network of our automated sorting centers, say we have in the top 5 locations or the top 7 locations, then we will see the real impact of the cost savings coming in. And then that's not too far away. I think in the next 2 years, we will have all the major centers fully automated. And that will at least help in about 100 to 150 basis points in direct cost savings.
Now you're evaluating land in Mumbai, Chennai, and Bangalore. So which city is it that is closest to closure, and what's the strategic rationale for you prioritizing it?
So Chennai again is something which is actually Mumbai is much closer to our finalization of the new mega sorting center that we're going to be building. Uh, the rationale is very simple. Wherever the business is being generated the most, we will put focus over there. And Chennai is coming up quick, but not as fast as the Western India. So our focus, as mentioned, was Ahmedabad, and then we're doing Mumbai, and eventually in the east we will have the Calcutta sorting center, and south will be the biggest in Chennai.
Let's focus on SME now. B2B mix returned to almost 50-50. Is SME demand now recovering, or was Q1 a non-quarter bounce?
Actually, Q1 we saw a very good bounce back of the SMEs, and that really helped in also our top line. Something which is I think the whole year is going to be quite progressive and quite with good growth. Interestingly, even with all that is happening with the geopolitical and the costs rising, the demand itself is quite robust for us to see the high volumes and the high profitability.
All right, Mr. Agarwal, appreciate your speaking to us on NDTV. Thank you
Thank you.
on ET Now. Thank you very much for joining us.